every Monday to Friday. This is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis welcoming you to Money Talk, and thank you for making this podcast one of the top 10 most listened to finance and investment podcasts on Apple Podcasts in Hong Kong. We're also on Google Podcasts and Spotify. If you go to my website, peterlewismoneytalk.substack.com, you'll find all the details of how to listen to the show on your smartphone using your favourite podcast app, and you'll also find there my daily newsletter, which contains a lot more business and finance information from around Asia. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. Here are the headlines for Wednesday the 7th of June. The US has charged Coinbase, the biggest crypto trading platform in the country, with operating illegally and widening its crackdown on the industry. The Securities and Exchange Commission said Coinbase had acted as a broker, exchange and clearing agency for investments that are subject to SEC rules without properly registering. The regulator said that had allowed the firm to escape oversight, including guards against conflicts of interest. Coinbase said the rules were not clear. The World Bank on Tuesday raised its 2023 global growth outlook, while warning that factors like the war in Ukraine and tight monetary policy are keeping the economy in a precarious state. The World Bank said that global economic growth should reach 2.1% in 2023, compared to a forecast of 1.7% in its previous report in January. However, 2024 growth was revised down and is expected to stand at 2.4%, down from 2.7% forecast in January. The Reserve Bank of Australia again surprised markets and raised its benchmark rate by 25 basis points to 4.1%. Economists were widely expecting the central bank to hold its rates steady. This marks the 12th time the bank has lifted rates in the past year and pushed borrowing costs to their highest level since April 2012. Bloomberg News reported Tuesday that China has asked its big banks to cut deposit rates to boost growth. Sources told Bloomberg that some banks may cut their time deposit rates as soon as this week to stimulate consumer spending and boost credit supply. On today's programme, I'm joined by Wealth Preservation Specialist for Individuals, Enzio Pfeil, and Marc Franklin, Managing Director and Senior Portfolio Manager of Multi-Asset Solutions at Manulife Investment Management Hong Kong. And with a view from Japan is John Beirne, Vice Chair of Research at the Asian Development Bank Institute.
Money Talk.
On Wall Street, the S&P 500 advanced modestly on Tuesday to its highest close of the year ahead of next week's Federal Reserve policy meeting. The S&P 500 added 0.2%, closing at 4,284. That's almost a 10-month high. The Dow eked out a narrow gain of just 10 points, under 0.1%, to end the session at 33,573. And the Nasdaq Composite climbed 0.4% to end at 13,276. The CBOE Volatility Index, known as the VIX and also called Wall Street's Fear Gauge, closed at its low of the session Tuesday at 13.96, and that's its lowest close since February 2020. Hong Kong's Hang Seng Index gave up early gains to close 9 points lower, that's under 0.1% at 19,099. The declines were limited by rising property stocks on hopes that a new round of support measures will boost the beleaguered mainland real estate sector. Long Four Group surged 7.8%, while Country Garden jumped 6.2%. On the mainland, the Shanghai Composite Index dropped 1.1% to 3,195. And it looks like a strong open for Hong Kong stocks this morning. Futures are pointing to gains of around 250 points for the Hang Seng. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Time to welcome our guests. We have with us Enzio Pfeil, who is a capital preservation specialist for individuals, as well as being our regular Wednesday morning commentator. Morning to you, Enzio.
Good morning, Peter.
And also joining us, Marc Franklin, Managing Director and Senior Portfolio Manager of Multi-Asset Solutions at Manulife Investment Management here in Hong Kong. Morning, Marc.
Good morning, Peter.
The US has charged Coinbase, the biggest crypto trading platform in the country, with operating illegally, widening its crackdown on the industry. The Securities and Exchange Commission said Coinbase had acted as a broker, exchange and clearing agency for investments that are subject to SEC rules without properly registering, and the regulator said that had allowed the firm to escape oversight. Coinbase said the rules were not clear, and the enforcement action comes a day after the SEC filed a complaint against Binance and its chief executive officer Changpeng Zhou, who is now together Coinbase and Binance accounts for half of global trading in digital assets. So, Marc, I notice you look at multi-asset solutions at Manulife here in Hong Kong. I'm wondering where digital assets, cryptocurrencies, where do they fit in the multi-asset picture, and is that something that you consider?
Good morning, Peter. So one of the things that we always look at is to what extent does a new asset class enhance risk-adjusted returns to the existing set of diversified assets in a cross-asset portfolio. And I think most people would agree that over the last 5 years, the level of volatility in cryptocurrency and digital assets has been very, very elevated against returns which have been extremely unpredictable. And so on a risk-adjusted return basis, actually, as we stand now, cryptocurrencies don't figure that attractively against other asset classes for either institutional or retail-oriented multi-asset products.
This does suggest, though, doesn't it, that there's going to be quite a big problem for the crypto industry, because two firms that account for half of the trading there are now under investigation. I'm wondering what this means for the industry going forward. And I was particularly interested by Gary Gensler's comments. He's the head of the SEC, the US Securities Watchdog. He said the whole business model is built on non-compliance with US security laws, and we're asking them to come into compliance. I mean, that's really quite a damning indictment of the whole industry, isn't it?
It's taken a while for the SEC to get to this point, hasn't it? Let's be honest. The criticism would be that they are effectively chasing a phenomenon which has been in play for many, many years, and it's only after substantial losses were incurred on owners, both retail and institutional, in the crypto space. The reality is, when you start assuming that the assets that are being traded, or either some of the activities that are being taken, are regulated activities or securities, then indeed you have to treat cryptocurrencies and the trading of that like any other financial assets. That will inevitably increase the costs of doing business, but it doesn't necessarily signal the death knell for this as an asset class. All it does is effectively legitimize it. But clearly, some of the marginal volume-oriented activity will be affected in the long term.
And what does it mean, do you think, for Hong Kong and its ambitions to be a trading hub, a global trading hub for digital assets?
Hong Kong has looked at the ecosystem that's built up around cryptocurrency in Singapore quite enviously, and there's been a huge amount of job creation, wealth effects from that, and it's decided that as a financial centre, Hong Kong should also have a capability and a proposition. That need not be dealt a serious blow by this, but clearly the emphasis will be on making sure that retail investors are adequately protected once this becomes a greater presence in the financial landscape of Hong Kong.
Oh, okay. Well, we're going to turn to some of the real asset classes in a moment. Before we do that, let's talk about some of these economic support measures coming out of the mainland. China's reportedly working on a new package of measures to support the property markets, after Beijing's comprehensive 16-point plan from November failed to sustain a rebound in the ailing sector. And that's going on at the same time as China is also reportedly pressurizing banks to cut their deposit rates to boost the economy as well. So Enzio seems to be, Beijing is rolling out a number of measures now, obviously concerned about the ailing mainland economy. But do you think these measures are going to work, and particularly the new support measures for Chinese property?
By definition, not. China is facing a D-Day, a decision day, where the leadership has to decide whether it wants to really pursue Marxist ideology, which it's been doing, or whether it wants common prosperity, really driven by the private sector. The private sector, after all, accounts for about 80% or 60% of GDP and 80% of urban employment. until the Chinese government has decided which one it wants, it's going to go nowhere with tinkering around at the edges on property rates or indeed the local government financing vehicles, because these are all measures designed to try and outguess what the market actually should be doing. And my old teacher von Hayek always said you cannot outguess the market and what it should be doing. That's for the market to decide.
But isn't China? It isn't really much of a choice, is it? Because isn't China's version of common prosperity? It's not the capitalist version that you describe, where the markets dictate where capital is allocated. It's a redistribution of wealth, isn't it? That's really what China means by its version of common prosperity.
Yeah, but there has to be wealth to redistribute. And the problem is that by trying to go very dirigiste, which is also what's happening in Hong Kong, they are killing a lot of the incentive of the private sector to create precisely the prosperity which they want to distribute. So I think it's kind of a chicken and egg situation. I'm more for the chicken than the egg.
Do you think they will work, though, these property support measures? They didn't work back in November, did they, with their 16-point
plan? No, I don't
plan?
think so. I just think that, again, it's on a very broad level. It's just trying to tinker at the edges, and I don't see how they can work, particularly also on the local government debt, because they have rising refinancing costs, troubling property sector, renewed infrastructure spending. These are all local government problems, and it already stands at 66 trillion, the local government debt. That's twice 2017. So they're really digging a hole that just isn't going to get going.
Mark, if these measures, or every time they're reported, they seem to have quite a big impact on the markets. We saw this big 4% pop in Hong Kong shares on Friday. The yuan rallied briefly, although it's back down again. We also saw some commodities rally, like copper, iron ore, crude oil, sort of up when they were first announced. But do you think these are significant measures that investors should be taking notice of?
If you look back to the start of the year, there was a level of optimism in markets that China's policy mix would shift towards a pro-growth agenda. Fast forward 4 or 5 months, there hasn't been a great deal of evidence that is their inclination. And as a result, we saw a loss of confidence in the cyclical growth picture, the recovery picture for China in absence of that stimulus. So heading into Friday's news flow, which came out after the market, Hong Kong China equity sentiment had really become quite depressed. And so the timing of this headline was very, very sound, in the sense that it came at a time when sentiment was really on the floor. What we need to look out for now is signs of actual evidence and action. It is important, even though actually property prices in China have started to stabilise, clearly sales volumes remain very depressed. And that is an overhang, unfortunately, from the last 3 to 4 years, where there was a significant depletion of household savings, a loss of confidence, and people already, as a share of their total assets, already own a lot of real estate in China. So it's going to take a lot of effective and targeted action to stabilise the real estate sector and effectively attempt to rebalance supply and demand.
I presume also there's some quite big problems overhanging it. I mean, you've got a 20% youth unemployment rate, so those people aren't going to be buying homes for sure. And presumably that has a knock-on effect, because maybe some of them are being supported by their parents, so they won't be buying new homes. And then you've also got this demographic change. People are waiting much longer to get married, so you don't have these young couples wanting to buy homes either. It's going to be quite a difficult thing to revitalise this market, isn't it, under those circumstances?
I mean, the observation would be that the real estate sector in China is starting to face similar demographic and socio-economic challenges that some property markets in the West are facing. I mean, London, my home city, the affordability of real estate has been a problem for first-time buyers and young people, young professionals, for a long time. And what that's resulted in is a lack of new supply of housing at affordable levels. And you've seen during the good economic times, speculative build-up of asset prices at the higher end. So it's become a market which is dominated by the middle and the upper echelons, whereas actually what you really need to do is make sure that the base of the pyramid is in healthy order.
Enzio, how much do the demographics really overhang on this and make almost any measure that Beijing tries to come out with very difficult?
Well, I think they're insidious. They will creep up more and more. But I think laziness is also a big theme. The lie down generation, a lot of them don't want to work. That's why you have about 20% unemployment amongst the college graduates. Now they do have something called a flexible employment, where 16% of college graduates in 20 and 21 decided that they wanted to actually just go work from home, do their own little gigs, but that's not going to pay for a mortgage either, as you say. And so I fully agree with Mark that this is a theme that is just continuing. Really, what we've seen in the West is not going to be different in China.
And how big a problem is local government debt in terms of its overhang on the economy? Because presumably, with all this debt in the system, and I think it was Goldman Sachs estimated, S&P Global Ratings estimated these local government financing vehicles stand at about $6.5 trillion. That presumably means these local governments also can't stimulate the local economy. They can't borrow very easily, and it's going to be very difficult for them to take action.
Precisely, because they, again, are trying to apply Keynes and Marx, which is a little bit of a hairy issue for any economist. They want to have Keynesian stimulus with Marxist dirigisme. And the difficulty with that is that what we in economics call the marginal utility of additional infrastructure spending, the additional jobs being created, is waning, because how many roads and bridges can you really build? So that they keep on building these things, that gets them into more and more in the hole of debt. Then you have a tumbling property sector, what we just discussed, and rising refinancing costs. And the whole thing is just a bit of a bad brew. So the 66 trillion that the IMF has tagged on the local government financing vehicles, I think that's pretty more like 100 trillion, frankly, once you add up all the numbers. And it's just going to get worse.
Mark, when you make your lists of risks, if you like, and worries that could affect, the forecasts going forward, where does local government debt fit into that?
The extent to which there's a lack of fiscal room for the traditional approaches to stimulus becoming limited is a factor in making us, as a base case, have a fairly muted forecast for the growth outlook there. Historically, central government in China has wanted to keep its own balance sheet relatively clean, and so a lot of the leverage built up in order to stimulate via infrastructure products and so on has been directed via the local government funding vehicles. In addition to that as well, because of the real estate sector muted cycle, they've had a lack of revenues coming in from land sales. So they're being hit by both sides, revenues as well as tax receipts, as the economy is slowly recovering after a period of 2 to 3 years of weak growth. And so there would need to be a shift in the willingness of the central government and the use of its own balance sheet to stimulate, which that has not been the case for decades, never mind years.
And what tends to happen, isn't it, when economic growth starts to slow down, they fall back on their own playbook of sort of ramping up infrastructure investment to try and get the economy sort of ticking again. Is that the risk that, they're just going to revert to that again?
There was evidence of that for the last few months. In addition to that as well, the GDP growth pickup in the first 4 months of this year, in retrospect, was catalysed by a ramp up in production of coal, of steel, and so on, and those are important drivers of GDP in the short term. Of course, that's not sustainable, and the long-term vision that China has is to be a consumer-led economy, becoming increasingly value-add and sophisticated. So you need to reactivate the consumer, and whilst consumer spending is in growth territory this year, it's not growing at a particularly fast pace, and that's why they've had to lean on traditional levers of stimulus. But going forward, it will come down to consumption, services, for a sustainable mix of growth drivers for the future of the Chinese economy.
We did see quite good numbers, didn't we, from the Caixin Services PMI, which seemed to suggest that certainly in the services sector anyway, the consumer was still spending. Obviously not great numbers for the manufacturing sector, though.
There was a bit of a dichotomy between the official PMI data and the Caixin PMI data. The official PMI data showed a slowdown in the composite PMI to 52.9 from just above 54, whereas Caixin's composite PMI increased slightly. I think what you're seeing there is a difference between the complexion of the indices. So the official PMIs tend to lean more on the state-owned large enterprises, whereas Caixin is more the small and medium-sized enterprises leaning and perhaps a bit more export or outward-facing. So I think one of the takeaways we would have is that the large state-owned enterprises are clearly showing signs of pressure. But on the encouraging side, perhaps the more export-facing, more private sector-oriented small and medium-sized businesses are relatively constructive on the near-term outlook.
Enzio, we've got some new World Bank forecasts. They've raised their 2023 growth outlook higher, but cut their 2024 forecast. They say that global economic growth should reach 2.1% this year. They were forecasting 1.7% in January, but now they're saying 2024 growth is expected to slow to 2.4%, down from their previous forecast of 2.7%. On the US and China, they've revised up the US to 1.1% from 0.5% this year. China's economy expected to grow 5.6%. It was forecasting 4.3% in January. Big changes in just, 3 or 4 months?
Well, let me start with what a camel is. A camel is a horse designed by committee. And what the World Bank and all of these organizations do is they kind of huddle and then decide what is politically correct, what should they be saying. I think anybody, as Mark and I have been discussing with you, the Chinese economy outlook, for instance, is not good. The American economic time is pretty bad, with an excess demand for money, excess supply of goods, even though the market has been pushed up by forced stocks. We all know that. So I look at these official forecasts with a great deal of leeriness. How can world growth be growing when, in fact, world trade, and you speak with any shipping magnate here in Hong Kong, is slumping? How can world growth be growing when consumption is slumping? Property prices are beginning to slump, at least in the major economies. I'm not getting something here. This time is not different. Rising rates do kill demand.
Mark, let me get your thoughts on the markets. It's been an interesting sort of month or so, hasn't it, really? We've seen this big switch out of Chinese equities into Japanese equities. We've also got the US markets, which is at a 10-month high, but the concern there is that it's virtually being driven by just 5 stocks: Apple, Microsoft, Alphabet, Amazon and Nvidia. They account for 25% now of the S&P 500's market value. Do you worry about this concentration that we're seeing now in these huge mega cap tech shares?
Well, just very quickly on Japan, Peter, and I'll come on to the US. Japan is benefiting from a number of factors. One, the actual return on equity profile and shareholder policies are improving over time, with a greater scrutiny from institutional investors there. So that's a tick in the box. In addition to that as well, the weaker yen has been helpful as a tailwind for exporter-leaning earnings. Japanese policy has been relatively stable, even though the market tries to second-guess the Bank of Japan's actions. Monetary policy settings are very loose there. And in addition to that as well, because of people's degrees of discomfort with the outlook for China, they're finding alternative homes for their capital within the Asia-Pacific region. And so Japan is a beneficiary market, as well as a couple of others. Coming on to the US, to the extent that the narrowness of the market is not resolved by other sectors catching up, then yes, it will continue to be a problem, and it's ultimately not sustainable in the long run for such a small number of stocks to drive the market, and concentration risk is relatively elevated right now compared to previous cycle peaks. So you really need other sectors to start to cooperate and to participate. In the absence of that, then yes, the market construct will take on growing fragility if it keeps going up and being led by such a small number of stocks.
Do you think the worst has been priced into Chinese equities? I mean, there's been a lot of gloom, hasn't there, over the last month or so about the forecast for growth on China, and clearly it's disappointed from what people were expecting at the beginning of the year. But having said that, there are still some positive things, aren't there? I mean, earnings have come through okay-ish for Chinese companies. The valuations look quite good. So do you think maybe the worst is over?
Depends on what your time horizon is. If you're thinking cyclically, as in sort of 6 to 12 months, then you're probably going to conclude that a degree of concern has already been discounted in market valuations. Structurally, though, if you take what Enzio is saying as the base case of the direction of travel in policy making and the economic model, structurally there are big problems that need to be resolved. In the absence of that, then valuation multiples over the longer term will continue to face downwards pressure, and there will be a floor under risk premium. So ultimately, short term, yes, perhaps a lot of concern is factored in, but longer term, it's still unclear where this ultimately will resolve.
Enzio, one of the things that foreign investors have been saying is, and they've been big sellers of the Chinese markets, is they just can't think of a catalyst to be in the market at the moment because there's so many big things playing against it, like the geopolitical tensions, like the crackdowns that we're seeing on various sectors. It's put foreign investors off, and they can't see something new that's going to persuade them to go back into the markets. What could it be, maybe, that will get investors back into China?
Well, again, I'm going to rattle my old drum. That it's this decision whether they want to go more to allow the private sector to create that 90% of employment, which it's always done, yes or no. Are they going to allow it to do it on its own, yes or no? Because if they decide they want to continue being dirigiste, then basically China becomes a Japan, and Japan becomes China, China Japanizes and Japan Americanizes is my bottom line. So I think that it's the key. And then, of course, the second thing that we all know about is that the U.S.-China tension is not going to go away. I think that the Americans have been picking a mighty big fight in the run-up to the presidential elections, and that isn't going to go away, certainly not for a long time.
Mark, let me ask you about the currencies as well, because we're seeing some movements there, aren't we? First of all, the Japanese yen, it's weakened to about 140 now. It's getting around the level where last year the Ministry of Finance intervened to sort of prop it up. Do you think we might see the same again, and will that provide some support to the Japanese currency?
We'd actually identified areas within which the Bank of Japan might signal that they think that the move has gone far enough, and we came to the conclusion at Manulife it's sort of 142 to 145 against the dollar, without being precise about that. The reality is that interventions historically have typically worked for a brief period of time, but then market fundamentals reassert themselves, and ultimately this has been driven by rate differentials. So a greater degree of elevation of interest rates for longer in the US has started to be priced in again, and whilst the Bank of Japan stands pat in terms of its monetary policy, and so that's led to a widening of rate differentials, a widening of real yield differentials, and that's why the dollar has been appreciating against the yen. If that factor continues, then yes, the weakness in the yen will continue, even with periodic interventions by the Bank of Japan.
And what about the Chinese yuan? That's at the $7.11 mark now for the first time since November last year. Is that reflecting the state of the Chinese economy, do you think?
Principally, it's reflecting diverging monetary policy paths. So, as I mentioned, the US Federal Reserve continues to raise interest rates. Perhaps we're close to the end of the rate hike cycle, whereas actually there are signals that the PBOC may be cutting interest rates in China, albeit from a relatively low level as well. So again, that rate differential point as a driver of currency pairs is widening most aggressively between the US and China, even more so than the US versus Japan. So that's explaining the weakness there. And perhaps also some market participants would have concluded that the RMB was actually being artificially strengthened and held up in recent months. And so this is a case of the PBOC effectively allowing a greater influence by market forces.
Well, thank you both very much for your thoughts this morning. That's Marc Franklin, who is Managing Director and Senior Portfolio Manager of Multi-Asset Solutions at Manulife Investment Management in Hong Kong, and also with us our regular Wednesday commentator, Enzio von Pfeil, who is a capital preservation specialist for individuals.
Peter Lewis's Money Talk.
I'm joined now by John Beirne, who is Vice Chair of Research at the Asian Development Bank Institute. Morning, John.
Good morning, Peter. How are you?
I'm very well, thank you. I want to kick off by asking about Japanese markets, both the yen and also equities. The Nikkei 225 back up to its highest level now since July 1990. What's driving this surge in Japanese stocks? And is it something that's going to be sustainable? Because we've had some false dawns in the past, haven't we, on Japan?
Yes, so the stock market has been gaining significantly during 2023. And I think there are a number of reasons for this. I think, firstly, there's a perception that there's an undervaluation in stocks in Japan at the moment. And we saw recently some visits by US financiers to Japan, essentially about increasing levels of investment. I think also that the level of the yen is something to bear in mind as well, which may make investment in Japan at the moment quite opportune. And on top of that, of course, let's remember there are some issues around inflation coming back, and this has also prompted some shift into stocks particularly from depositors, for example. As well as that, there are also moves by Japan to increase the high-tech sector as a source of resilience for the global supply chain. And this has prompted some sector-specific increases in that area.
And how big an impact has that had? Because there has been this sort of global frenzy, hasn't there, for AI-related stocks? And of course, Japan does have those types of companies. It has companies that make the materials that some of these AI chips need. It also has companies that make things like the servers, the cloud servers that all this needs as well. So presumably Japan, along with maybe South Korea and Taiwan, these are sort of key beneficiaries in Asia from this euphoria over AI.
Yeah, that's right. I think one of the notable things recently has been the upsurge in investment in semiconductors in Japan. And what we saw recently, of course, with the pandemic and also the situation in the Ukraine has been some vulnerability to the supply of semiconductors. And there's been a large government policy shift towards investment in this area as well. And I think that, it will be certainly one of the factors which contributes to the potential output of Japan over the longer term. But there are clear obstacles in that regard as well, not least in relation to, for example, the demographic issue, which remains to be something that Japan needs to address, as well as issues around flexibility in the labour market, which is also something that needs to be addressed as well.
Now, the other thing that I've noticed that seems to be going on is we seem to have a lot more activist shareholders in Japan, and they're actually taking steps. They're removing directors, chairmen, CEOs of underperforming companies, and we've seen this in some quite major companies. And as a result, they're forcing Japanese companies to focus more on shareholder value and increase dividends, do more buybacks. How big an impact is that having on the market, and in particular foreigners' perception of the Japanese markets?
Yeah, certainly. It's also one of the contributory factors to what we've seen in the stock market during this year. More broadly, I would say that there has been a shift more towards performance-related pay as well, which is also related to this issue, of course. And I think that all of these factors are helping to increase the perception of Japan as an investment location for foreign investors. So I think all of these factors in combination with the issues that we discussed at the beginning are contributing to an upward trajectory in share prices, and whether it's sustainable is something that remains to be seen. I think that issues that we see in terms of inflation and the sustainability of inflation will be important factors. Measures to address the demographic issue, which I touched upon, will be another important issue, which will, obviously affect the potential output over the longer term. But I think that these moves are certainly to be welcomed. And
these companies, a lot of the Topics companies, they're awash with cash, aren't they? A lot of excess cash, which presumably now maybe we'll see more of that being returned to shareholders. So this effect could continue for a while.
Yeah, certainly it could continue for a while, and there will obviously be spillovers of this type of development to other parts of the economy as well. And this is something that's very important at the current juncture. Domestic demand is something that is still, it's building up, but I think there's more to be done there. And I think that developments that we've seen recently are certainly supportive of improving domestic demand and perhaps sustainable inflation over the longer term.
And what about the Japanese yen? It's around 140 at the moment against the US dollar. It's getting quite close to that level, isn't it, where the Ministry of Finance intervened last year when it touched 150 against the greenback. They then intervened to go and support it. Are they making any signs at all, or trying to talk the currency up and indicating that they may do the same thing again?
Yeah, well, I mean, I think the fundamental issue driving the movement of the yen recently remains the same as it was last year. So this yield differential between the US and Japan, and some stickiness in inflation in the US has basically, flagged some rises in interest rates to continue in the US, albeit at a smaller pace. Whereas in Japan, of course, we still have the accommodative stance. Whether there are going to be actions taken in terms of intervention, I don't see signals of that at the moment. We're at the 140 level now, of course. The last time we were at 150, which was a much more severe sort of a threshold level. But there is some evidence that there is increased speculation shorting the yen at the moment. But I think it remains to be seen whether there would be action taken.
And I suppose that makes the economic data even more important then, doesn't it, in terms of that yield differential between Japan and the US. And what we've seen in the last couple of days tends to support the Bank of Japan's view that maybe it's too early to start raising rates. We had that data on real wages. Real wages contracted for a 13th month, fell by 3% in April. Average cash earnings also slowed, rose by 1%. This rather supports, doesn't it, the Bank of Japan's fear, which is what has happened before, is that it stepped in and raised rates too early when the economy still isn't fully back on its feet.
Yeah, that's right. I think, the real wage data that came out was over the year to year, of course, which does not really include the recent negotiations on wage rises. So hopefully some of that will start to slip through in the next months and achieve some more shifts towards a positive real wage growth situation. But again, it remains to be seen. I think the Bank of Japan will meet next week, 15th and 16th of June. And one of the key issues, I think, will be looking at the underlying inflation, so excluding food and energy. And there are some signs that, underlying inflation has also, tipped 3%. So, yeah, understanding whether it's sustainable is something that is very difficult at the moment, and that would be a key part of the discussion, I would say.
Do you get the impression that central banks are winning the battle against inflation around the world? The data that we've seen coming out recently from the Eurozone, also out here yesterday in Thailand, in the Philippines, tends to suggest that inflation is now falling. Do you think the battle against inflation is being won?
Well, I think that there's certainly been a turning point. We saw this already in the US back in November when it slowed down its pace of tightening. And, I think that the US, of course, is very data dependent, and recent data coming out of the US suggests that it may even skip hikes over the next couple of meetings. Of course, remain tightened in terms of its monetary stance. So I think if we compare, certainly if we compare to towards the end of last year, we are winning the battle. I think there are still some issues to get over in order to really beat the inflation completely. But I think that we're moving in the right direction, certainly at the global level.
And what is the data telling us about the state of the Japanese economy right now? If I look at what we've had in the last week or so, it's sort of a bit of a mixed picture, isn't it? We had the services sector PMI expanding at a record pace, but then retail sales, industrial production, both missing estimates in April. What do you think is the state of the Japanese economy?
Well, I think that it depends on what measure you look at, of course, and it depends on what period you look at the change in that measure. I think that what is clear is that since the start of May, when all of the restrictions on the pandemic were finally removed, we have seen a clear increase in tourism numbers, and this has led to, the drive in service sector growth, which you alluded to earlier. So I think that on that front, that should increase further the scope for developing domestic demand-driven inflation towards the end of this year. I think on the domestic side, in terms of consumption and business investment, obviously accommodative monetary policy is contributing to growth in that. The external side is something that is remaining difficult. So exports and achieving net exports, in spite of this level of the yen, is still something that remains a hurdle for the economy.
But in terms of investors, and particularly foreign investors, Japan's sort of seen as a safe alternative for China these days, isn't it? It sort of doesn't have the same geopolitical problems that China maybe is having, but nevertheless, it's a lot of its companies operate in China and have big businesses there in China. Is that how you're seeing it? That maybe this is a good way of playing China without the risk?
Yeah, I think, one of the things that came out of the G7 summit at the end of May was it's crucial to really de-risk the global economy. And that, of course, includes the economies of Asia as well. And part of that will involve diversifying supply chains across the whole region. So I think that, it's important not to exclude any one part of that supply chain. And, of course, China is a huge player in the global supply chain, and it will be important to, remain connected to that supply chain, but in a manner which is not leaving one economy in particular exposed or in any way vulnerable. And that's something that we learned from the pandemic. That's something that we learned from the Ukraine situation, and that's something that's underpinning, drives by different economies to invest in particular sectors and to diversify their involvement and participation in supply chains.
John, it's always a pleasure talking to you. Thank you very much indeed.
Thank you, Peter. Take care.
That's John Beirne, who is Vice Chair of Research at the Asian Development Bank Institutes. And thank you for listening this morning. Just a reminder once again to take a look at my webpage, peterlewismoneytalk.substack.com, where you'll find my daily newsletter with a lot more business and finance news to go with this show. I'll be back tomorrow when my guests will be Andrew Ferris, the CEO of Econosis Advisory, and Andrew Sullivan, founder of Asian Market Sense. And to talk about the oil markets, I'll be joined by Vandana Hari, founder of Vanda Insights. Please catch me again tomorrow.
Money Talk